It's time for Wise Money with Korhorn Financial Group with financial advisors Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of Wise Money with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. My name's Mike Bernard. I am your host as well as one of the certified financial planners on the show. Next to me, my business partners and colleagues, Kevin Korhorn and Josh Gregory.
Unless you've been living in a cave, then you no doubt have heard the huge political news here recently in the past 10 days that taxes are officially changing next year. Mm-hmm. And so the number one question that should be on your mind is, what does it mean for me? We're going to help you answer that today. Start unpacking the tax code changes and what you need to do about it for 2018.
That's the most important thing, because everyone's thinking about, well, what did the government just do that will change my tax situation? No, what do you get to do now to improve your tax situation under these new rules? We're going to tell you that. If you have questions, reach out to us. You can do so in a few different ways. WiseMoneyRadio.com. You can catch up on previous episodes as well as submit questions right there on the right. Call or text your questions in to me, 574-222-2000. Lastly, YouTube channel, Facebook, and Twitter at Wise Money Radio. So, like Josh said, although I like that terminology, unless you've been living in a cave, which actually would be a little appealing considering how much this has been smeared across the news, but taxes are officially changing next year, and it was not what was campaigned on. It was not what was promised, but there are changes nonetheless. Before we get into what those changes are, and then more importantly, what planning opportunities are out there for you, let's just recap the whole process.
Yeah, well, lots of changes have been made. One of the things that we were going to talk about as well is what should you do today? This is really the last day for you to take action. And I'm just going to throw this out there. If you estimate, and you're planning on doing your fourth quarter estimate January 15th, do it today for your state and local taxes. Get that estimate written, get the check written, get it postmarked today, because they're going to be limiting how much you can deduct. They're going to limit that to $10,000. Mm-hmm. And so if you pay more than $10,000 in state and local taxes, you won't be able to deduct anything north of that for 2018. So bring that payment into 2017. And that's one of the things that if you're listening today and you're saying, hey, how am I affected? That's one of the things that you should do. The tricky thing about covering the tax law change is everyone wants to know, how does it apply to me? It applies to everyone. It just applies to everyone differently. Mm-hmm. So the planning opportunities, the changes, and how you're affected, it is very unique and individual. That's why you want to be working with a certified financial planner who is working with your tax planner.
Well, you said there that it applies to everyone differently. It also applies to everyone differently than it was kind of billed at the beginning. I have read way too many articles, and in hindsight, I realize now how many of them were really kind of speculative in nature. Mm-hmm. The media has been presenting on all of the different iterations of the bill, and this is the first major bill that I've ever actually combed through myself. Normally, we study up on the main provisions and everything, but going to the actual document was fascinating to me. The understanding the process that they've been going through over these months, where, the House created their version, the Senate creates their version, and then they go into conference to arm wrestle over which one's going to win. Yeah. And when you read the actual document, it shows you, here's what the current law was in 2017, or prior law. Here's what the House said they were going to do. Here's what the Senate said, and here's who won. And frequently through this, I see the Senate winning over and over again.
Which actually is a huge irritation to me, because I was a big fan of a tax change and tax simplicity and improving taxes for the middle class. And the House proposed a plan that didn't quite do that, but it was an attempt. And then the Senate came out with a plan that didn't do that at all, in my opinion. And when they went to tug of war, the Senate won, and frankly, I'm disappointed. Now, we are going to talk about what those changes are, what you need to be doing about it. Kevin just started sharing, but it's a disappointment to me how it all shook out.
The House version was certainly more drastic, right? It was much more simplified. It was not going to get us, in my opinion, anywhere near the postcard tax return.
No.
As was kind of promoted there. But, you look at the Senate plan and the one that actually got passed, and it looks awfully familiar. Looks awfully similar to what we've known for a long time now.
And the interesting question that I get quite frequently, folks will say, "Hey, you guys prepare taxes," and we do. Our firm does about 2,500 tax returns every year. And people say, "Well, you want it to be able to be on a postcard, but that will really hurt you." And I said, "No, actually, that won't hurt us. As a matter of fact, in my humble opinion, that will ignite a firestorm because there's so much talent that goes into tax preparation every year. And when you look at the millions of hours of compliance in preparing tax returns, to me that is wasted.
Absolutely.
It is completely unnecessary. And my executive summary of this whole thing, as I've looked at this, and as I said on an earlier episode, I'm going to do it like I like to do a Notre Dame football game. I'm going to wake up with 5 minutes left to go in the game and watch the last 5 minutes and then know who won.
So you DVR'd this whole
I did.
tax law change process?
I did, and I did the super speed through the whole thing. But I was thinking about this, and if I was going to give you a summary, I would say the way that the politicians in Washington have behaved, you would not let your children get away with that kind of behavior. I mean, this is a very disappointing result. When I talk to our team about why did you come to work today? To get results, period. Mm-hmm. And the folks that we've elected and sent to Washington, D.C., we sent them there to get results. These are, in my humble opinion, this is my opinion, very disappointing results. But let's dig in.
Let's dig in. So the first thing that you'll notice that is a change, and gosh, I almost said big change, but it's not. The tax brackets are going down. Their tax brackets are changing. Now, I really like the idea of dropping to 3 tax brackets. We didn't get that. We have 7 right now, and there'll be 7 next year. But those rates dropped a little bit. They both start at 10%, but then 12%. And 22%, 24%, and so on. So you're going to be paying taxes at lower rates.
That's true. The question is, will you be paying tax on more money, though?
That's right.
Because what we never really spend a lot of time talking about is that there really is a 0% tax bracket, essentially. Mm-hmm. There's a chunk of your family's income that you pay no tax on because you use certain write-offs, certain exemptions or deductions. I'm throwing a lot of jargon out here. And if they start tinkering with those numbers, as they have, then suddenly you can have less money in the 0% bracket than ever before.
Right. And the tricky thing when you're talking about this is, Joshua, you're talking about federally.
That's
right.
Good point.
So there is federally, when I look at paying my federal taxes, it's not based on my income. It's based on everything on the front page of my tax return minus what used to be my deductions and exemptions. Now it will just be my deductions. But the state tax is it's a much lower rate than the federal tax, but it's much closer to a flat tax. There aren't very many gimmies or giveaways on the state side of the house.
And the state side is not a progressive system, which, as we're talking about tax brackets, just to remind you, so you've got your income after all those deductions, which we're going to go through in just a minute. A lot of those are changing, some of them going away. After all of those deductions, you then pay a certain amount you pay tax on a certain amount of your income at 10%, then at 12%, then at 22%, where it used to be 10, and then 15, and then 25, and then 28. We're seeing all those brackets come down slightly. The verdict is still out, though, or the jury's still out on whether that will actually be less tax to you because of these changes in in deductions. What deductions are going away? What's changing with your itemized deductions? What exemptions and so on? Folks, there's not much time left in 2017, but there's still some things that you need to do pertaining to these deductions. So we've got that and a lot more coming up here on Wise Money with Korhorn Financial Group.
30th, right?
30th.
That's right.
All right, we got some opinions out there. Let's inject a little laughter as well.
It's not funny.
We'll, and then
Dude,
let's start with
this is
deductions.
not a
I know,
funny topic.
This
It makes
triggers
me
all
mad.
my anger issues. Me too. I'm going to throw my pen just like Joshua did.
Yep.
As a matter of fact,
Josh is known for his anger.
Yeah. I
Actually.
just broke another computer screen, guys.
He was so mad a few weeks ago, he slammed his Surface on the ground.
That's the real story, huh?
All right.
his surface did connect with the ground and did need a serious.
I found a tax deduction for us, though.
Attaboy.
There you go.
Attaboy.
Squeeze that into
Keep
2017.
spending those dollars.
All right, so let's pick it back up with standard deductions and personal exemption gone, state and local income tax is capped, all that garbage.
Okay, so let's do that. Let's go boom, boom, boom. Right?
Yeah.
5, 6, 7.
Yep.
And now that my kids are out of the house, the child tax credit's gotten some much needed attention. Doggone gypsies.
Yeah,
Yep.
I'm not going to go into specifics for our YouTube folks, but Kevin in particular, you're going to be paying more tax. Yeah, this is not, you didn't win. So, yeah. We need to talk about winners and losers too on the show, because that maybe we'll get in there with that state and local tax.
But see, I wanted Kevin to win.
Yeah, I did too.
Everybody to win, even though I knew it wasn't going to happen.
Yeah,
So we have Casey, the virtue signaler, in the house.
yeah. Is this going to be the last year you itemize your deductions? Box that stuff up, rush over to Goodwill right now. Right now. There are things that you need to be doing here inside of 48 hours before that year changes, and we're covering all of that for you today. My name's Mike Bernard, next to Josh Gregory and Kevin Korhorn here in the KFG studios. This is Wise Money with Korhorn Financial Group. Special thanks to the attorneys at Ledoux, Kern, and Keene, as well as First State Bank for making the Wise Money Show possible. If you have questions, there will be tons of questions. I can't think of a more important time to do tax planning than ever before. You need to do tax planning. That's individual. You need to
Absolutely.
sit down with your certified financial planner who connects with your CPA, your tax preparer, and figure out what you need to do, what's changing for you, and what you should do to maximize the benefits. If you have questions for us that you want to hit on the show, a lot of people will. Reach out to us. Call, text 574-222-2000, wisemoneyradio.com. Lastly, every episode on YouTube and podcast, just search Wise Money with Korhorn Financial Group. All right, we left off with the number of tax brackets is staying the same, but the rates are going down. However, that doesn't mean you just won, because deductions are changing as well. Let's recap those deductions.
Well, I frame this as the 0% tax bracket, right? What portion of your income can you avoid paying any federal income tax on? And you've always had a choice as to whether or not you're going to create your own list of expenses to write off. We call that itemizing your deductions. Some people have used the phrase filling out the long form on their taxes, right? The other option is to use the freebie option or the gimme that the government offers, and we call that the standard deduction. It has dramatically jumped, nearly doubling. Right?
So the standard deduction is essentially doubling. I know it's not good to talk numbers on the radio, but if you're an individual, your standard deduction went from $6,300 to $12,000, and for married couples went from $12,700 to $24,000. So I think this was Congress's way of saying, see, we did simplify things. You don't have to keep track of all those things anymore. Actually, you just made things more complicated, in my opinion. about a third, if I'm remembering correctly, about a third of Americans out there itemize. I think even more could itemize. You just haven't wanted to. And this is going to, with the standard deduction doubling, it's going to drastically reduce the number of people who itemize, I believe. So,
Yep.
yep.
Yeah, so the incredible complications, because they have put some caps on some of the things that you can deduct it within your itemized deductions.
That's right.
That's why it's going to be so difficult for many people.
So share that, Kevin.
Well, so it used to be, when you talked about SALT, it was a Strategic Arms Limitation Treaty. So those of us who are political
I don't know if
junkies.
that's-
I
Is that
have
what
never
this show?
thought of salt that way, actually.
Right.
But
So now we're talking about it in terms of state and local taxes. So if you live in Indiana, you pay a state tax, and then you pay, depending on the county that you live in, you pay a county or local tax. So it ends up being about 5% if you live in St. Joe County, Elkhart, whatever. So if you pay more than $10,000 in state and local taxes, you're only allowed to deduct, because Mike was talking about, hey, you have two choices. I have a standard deduction. So a married couple, my standard deduction is now going to be $24,000, or I can itemize. And there are a number of things that go into my itemized deductions. One of those is my state income taxes that I pay. And that's why we're saying, hey, get any state and local income taxes that you would pay in January of 2018, pay them this year and deduct them.
If you think I'm going to owe state taxes when I file my taxes right now, if you think, well, or if you think it's going to be close, I don't really know, write a state tax estimate right now, drop it in the mail today. Before noon. No, that's not really a deadline, but get it done, because if you itemize this year, that 10,000 cap that will be on that state and local tax. I'm not using the salt thing. That, to me, that's not good. But for next year, it's going to be capped. It's not capped this year. So get that in, as it will help you. Part of the rationale around, well, we're doubling the standard deduction. I think part of it is to try and make it more simple, and that's in air quotes. I disagree. But they also got rid of that personal exemption. So any dependent in your family, and you're a dependent, you claim yourself, and as well as any kids or anything, you used to get just about a $4,000 deduction. So income that would be at the 0% tax bracket, like Josh said, is a write-off. So if you have, so you guys know, I've got a family of 4. It's about to be a family of 5. For each of those 5 individuals, you get a $4,000 deduction. That's $20,000.
I was waiting to see if you were going to do that math right.
Gone. Yeah, I know. You guys know I can't talk and do math.
I was ready to
intervene.
intervene for you if you messed up.
Okay,
so
I appreciate that.
I got your
Appreciate
back.
that. But if you've got a bigger family,
Yeah.
yes, there's one change we're going to talk about in just a second with child tax credit, but you're going to lose a ton of deductions here.
Yep.
A ton of deductions.
And essentially, I think the spirit of all this was they were raising that standard deduction, that free write-off, and erasing the exemption, just sort of merging the two together. And the spirit was simplify the tax return. But depending on how big your family is, as you say, you may be giving up much more than what you're gaining with the new standard deduction.
Based upon your income. Because if your income is lower, let's just say less than $100,000, and you've got 6 children, you say, wait a minute, I just gave up 6 times 4, Mike.
What? 5?
So I just gave up $24,000 of deductions, but if I have 6 kids times 2, I have $12,000 of credit now.
So let's get there. So the child tax credit received a little bit of a boost. So if you have child dependents that are under the age of 17, in previous rule, you would get a $1,000 tax credit, and it was completely refundable, which means all those kids in your house, if those created a lot of deductions and all of your income was gone, you still get that $1,000 tax credit even though you had no tax. So it was completely refundable. What they've done is, and there was rumor about they weren't going to allow it up to age 17, but they've kept that, is my understanding, that any kids that are dependents of yours up to age 17, you now get a $2,000 child tax credit. But if you're paying no tax, only $1,400 of that is actually refundable.
That's
so that should help offset a lot of losing that exemption for your kids.
It will help a lot of families, especially those who have always had their family income north of $110,000. Those families have always had some of their child tax credits taken away from them. Once you clear $110,000, they start phasing you out, is the phrase, but basically means they're taking some of those goodies away. Now you have to exceed $400,000 of family income for a married couple.
See, and that's where that's one sliver of the bill that I think, okay, I think you're trying to help the middle class. Now, you listening right now might say, middle class up to $400,000 of income? Maybe not. But if you are married and you and your spouse both work, making 55, 60 grand a year, I'd call that middle class. And in the past, you weren't able to get some of these credits. So the fact that they've lifted that, I think will help a lot of middle class where both spouses are working and they're making a decent money, but they're still in the middle class. Now you'll get these credits.
There's an interesting add-on here, too, because some of you listening may have another family member living within your home, within your household. Maybe it's a dependent parent or a grandparent or a niece or a nephew, someone that is not a child of yours. You've always been able to claim them on your tax return as an exemption, which that's the one that's based on head count, as Mike was saying. But now you may instead get a credit for those folks. That did not exist in the past. It's a $500 credit. It's also temporary.
Yeah.
So another complexity in all this is the rules are here today, but how long will they be here? That did not get more simplified.
Yeah, think of the adult children that are living in your house, whether that's a child with a disability or that is a child who's kind of boomeranged back. So this, right, the complexity, though, and I have to remember this, and I can claim it now, but it's going to change on the whim of the politicians. It's how about that?
What do you need to be doing to maximize your benefit? We've got that and more coming up here on Wise Money with Korhorn Financial Group. All right.
Do you think Goodwill takes pigs?
I've got my car is full. I'm not kidding. My car is full right now. Cindy, I told Cindy, hey, after the show, I'm going to come home. We're going to load up the car with Goodwill stuff, and we're taking it. And I was so motivated. Before I left the house, I grabbed boxes and started throwing it in my car.
Okay, so for the YouTube folks, there's a former president who gave stuff to Goodwill. Casey, do you remember the value that William Jefferson Clinton placed on his underwear?
Oh God, what was that?
Oh my goodness.
No.
$500 or something?
No,
Say it
no. I think it was $7 or $8, but it's still, a pair of used underwear that are probably color coded, and you're saying you're gonna say the value of those things is $7 or $8? Are you kidding me?
Oh, my goodness.
Wow.
Oh, Casey's researching it.
Yes, Casey is our research extraordinaire.
Okay, so a little bonus content for you on YouTube. So what you actually get to deduct is called thrift value. So if you bought a really nice pair of shoes and the shoes cost you $100, or they were Big Baller brand and they cost you $400 or whatever.
Did you say shoes?
Shoes.
Okay.
Big Baller brand. Come on, LeVar. No. Come on, he's all over.
I don't have any of those shoes. That's all I'm saying.
Okay, so
There are 3 people who care about Big Baller.
yes.
All of them are the family, and then you.
I don't care. I'm just talking about news. So anyway,
I didn't know they're making those in shoes now.
You pay this ridiculous amount of money for some Nikes or whatever, and then you donate them after you use them. You can't say, "Well, I paid $100 for these. I'm writing that off." No, it's thrift value. So what are they really worth if you were garage selling them? Oh, well, that's probably only $2. And yeah, that's the number you get to deduct.
Okay, Casey, what's the answer?
All right, so Bill Clinton deducted $6 for his used underwear, but there were 3 pairs of used underwear. So he valued his used underwear at $2 per pair.
Okay, so it's not as egregious as you mentioned.
Well, okay, so if you're walking through the garage sale and you see, oh, those are size 36, I'm size 36, $2 a piece. Yeah. Do you pass it by, or do you say, I'll see if they'll take $1 a piece
deal.
on these
You think
things?
he washed these?
$2 a piece, but having the President of the United States share a VD with you.
Priceless.
Wow.
Okay, I might edit that one out.
Okay.
All right, third segment. We're still hitting, just recapping, because there's 529 plans we need to hit, and teacher deduction, medical expense deduction, mortgage interest deduction.
I think the mortgage interest
We got to hit all that.
is fascinating.
Yeah.
Okay, so I've read a million different versions of this, but home equity line interest is out, right?
That's what I've heard.
Okay. In addition to that, they've capped
$750.
what size mortgage you can deduct the interest on.
Hey, so the 529, is it 10,000 per student or 10,000
I don't
in
know.
total?
We need to say the disclaimer again that, listen, even though the rules are out there, it's going to take some time for everyone to know exactly the details of them and how it all applies. There's a lot of misinformation.
He also valued one of his suits, with ripped pants at $75.
Oh my.
Would you take 72 for those?
Third segment.
I suppose I gotta create the audio file. Hold on. I was busy. Okay.
All right. So what really grinds my gears about this whole tax thing is everyone's looking at, did I win? Did I lose? How does this impact me? You can be a winner every single year on your taxes.
I'm a winner.
Here's how you do that. Do tax planning. Get proactive about your tax situation. And so I know there's a lot of hubbub about, well, how's this going to impact me? How's it going to impact me? That's all passive. Get proactive. Sit down with your certified financial planner and figure out which of these do apply to you, and then which new strategies do you need to start implementing to get the most out of these tax law changes. We're breaking down the tax law changes to you right now, and then we're going to start talking about some of these planning opportunities in just a second. My name is Mike Bernard, next to Josh Gregory and Kevin Korhorn in the KFG studios. This is Wise Money with Korhorn Financial Group. Special thanks to Bethel College Adult and Graduate Studies, as well as Diane Bennett with REMAX 100 for making the Wise Money Show possible. As we're recapping these tax law changes, let me just also add a disclaimer. There's been so much rumor going back and forth. There's a lot of misinformation out there. Additionally, you know that tax laws are very detailed, very onerous. We're getting headlines right now. It's going to take a little while to see exactly what details emerge, what exceptions to exceptions are out there, and it's just going to take a couple of months. There again, here we're at the end of 17. Set up your appointment right now with your certified financial planner to do tax planning. Set that appointment now.
Especially since a lot of the headlines, a lot of the articles being written are misinterpretations as well.
Yes.
So there's a lot of misinformation floating around out there.
Yeah.
Just be careful.
The folks that are writing those articles, as we did some reviewing of those articles this past week, they really don't understand what they're writing about. Doesn't make them bad folks, but they just don't get it. And so it'd be easy to be confused. As we said earlier, write a check today for your fourth quarter estimate for your state and local taxes. Get it postmarked and in the mail today. And don't worry. Another one of the big questions that we've had is, what is this going to do to my 2017?
Yeah.
It is nothing.
Nothing.
It is a non-event for 2017. People have said, hey, I converted my IRA to Roth IRA. I may need to recharacterize some early next year. Am I still going to be able to do that for my 2017 return? Yes.
Yeah. It doesn't impact your 17 return at all, and it's confusing because you'll file your 17 return in 2018, but it's based on the 2017 rules. Let's talk about the mortgage interest deduction. Speaking of itemizing, so pay your state estimate, and then also rush to Goodwill, make your donations, make your gifts here before the end of the year, because the standard deduction's doubling, but the things that you get to itemize, there are some limits to. So let's talk about that mortgage interest deduction.
So you can deduct, it used to be you could deduct the interest that you paid on a mortgage with the mortgage balance being up to $1 million. So if I
1 million. Sorry, go ahead.
1 million. So if I went and bought a house and got a mortgage for $1 million, and it was at 4% interest, I paid $40,000 in interest. I can deduct that.
That is ridiculous.
It is.
Wow. Can you imagine that payment?
I can't imagine having a mortgage half the size of what I've got right now. It's fascinating to even think about.
Okay,
that.
so you
We
used
need
to be able to
intervention
deduct
here.
all that interest. But
No,
not-
so yeah, you can deduct all that interest. Now they've made it, instead of $1 million, it's $750.
Yeah. So who's the big loser here in the? I'm going to say just right now, we still have a lot more details to hit. Big winners are corporations and business owners, but big losers are. If you, Kevin S. Korhorn. No, big losers are if you live in a state with high state taxes and really high home prices. So think Chicago, think New York, think LA, Atlanta possibly, because you're not able to deduct that mortgage interest that you once did. And with high income and high state taxes, you're going to be capped at $10,000 there on your itemized.
Yeah,
So-
it's not uncommon as I was reading, they're really in California, it's the big deal because it's not uncommon to have a mortgage north of $1 million. And we talk about winners and losers from the tax law changes, and I think I would feel like a loser if my mortgage was $1 million. But that's the reality out there. That's what stuff costs out there. So they're going to be limited, and this adds incredible complexity to the deal.
Yeah, that's right. Instead of making it more simple. Okay, what's still in? You can still deduct out-of-pocket medical expenses, and what went really under the radar screen during the Obama administration, that the cap got moved from 7.5% to 10%. So your out-of-pocket expenses for medical, you could only deduct what was over 10% of your income. They not only kept that as part of the itemized deduction, they brought it back down to 7.5%. I still argue with that. You should be deducting your medical premiums elsewhere on your taxes, hopefully through your Section 125 cafeteria plan, but then also your out-of-pocket expenses needs to run through your HSA.
If you're eligible
If
for
you're
that.
eligible.
That's right.
Yeah, and I would disagree with you there because you should be investing your HSA dollars and you should be paying for those medical expenses out of pocket if you're able to. But here's the thing: if this is a show all about whining about the tax code, the complexity it's still complex. And as a matter of fact, they just made the bar that much higher to be able to deduct those. So if you're going to go to your dentist and you say, well, I'm going to go next week and I'm going to get $10,000 worth of work done on this side of my mouth, and I'm going in January to get the other 10 done, you may want to do it all in January and February, get your $20,000, your new grill, and deduct it all in 2018.
This one felt like a shot across the Obama bow in a way.
It did.
I'm not sure how much of an impact it's going to have on a lot of people, but it does directly undo one of the tax law changes that he brought into effect over the past few years.
Student loan interest, you can still deduct that up to $2,500 of interest, and don't milk that deduction. Pay those things off. Get aggressive there. Teachers, this was a big deal. Teachers, you can still deduct your classroom expenses up to $250. Now, this one gets a lot of attention. It's just $250, but most teachers are spending that on their classroom. You can still deduct that. Speaking of teachers, there's a big improvement, in my opinion, to the 529 savings plan. Let's talk about those tax changes.
Yeah, they're changing who is eligible to use the 529 plan. It's always been thought of as a college savings plan. Now they're allowing you to use these dollars, but basically squirrel away money, let it grow, and use it for primary education or secondary education as well. That can be, private school for tuition for your kids.
Yeah, and I think that this is a huge deal. I was meeting with a client last week who's Amish, and I said, hey, do you guys put any money aside for college for your kids? And based on the way that they organize their lives and their religious principles, they don't do that. But they do send their children and have expenses for the school that their children go to. And now, this is a big deal if you live in Indiana, now I can put $5,000 in a 529 plan, get my $1,000 credit, and then pull out the amount that I need to use for my kids' education tax-free.
Yeah.
So there's a big planning opportunity there. It's a big deal.
You know, it also makes me kind of ponder how the states are going to respond to all these tax law changes. Everything we've been talking about have been federal rules, and then usually the states respond to try to coordinate their plans or react to some of the incentives that have been created. And as you mentioned, I mean, we've always talked about on this show, 529 plans are a way for you to set aside money and get a free credit on your tax return. That's a state tax return for saving for college. Well, does this open that up to more people using it? And is suddenly the state going to be on the hook for a lot more tax credits?
Yeah, just a little planning tidbit here as well. Josh and I both live in Michigan. We both pay Indiana taxes. We're both able to put money in the 529 plan and deduct it. You get the credit, if you will. In Michigan, you get a deduction. I'd rather have a credit than a deduction any day.
Moving expenses are gone. Paying your tax
and
prep fee.
And at the risk of interrupting, we're talking about things you want to get done before the end of the year. You may want to move.
Plenty of time this afternoon.
If you haven't
Add it to
started
your
that
agenda.
process. What about corporations? Are you going to see tax improvements for the small business you own, or if you're an owner in a larger business? We've got that and more coming up here on Wise Money with Korhorn Financial Group.
Okay.
All right, we got to hit the business stuff.
Dude, I think you should start out telling people, look, if you were going to move.
Yeah, but it's corporate
It's not funny.
pushed. Yeah, corporate required moving expenses. All right. Yeah.
The money, okay.
You mean moving for a job?
Yeah.
Yeah.
But look, the money they spent on tax prep software, that break has been eliminated. So I can't deduct my tax prep software expense, but I can deduct the expense of my tax preparer.
Can you?
Are you sure? I thought all miscellaneous
See there
deductions
again,
were
YouTube.
going away.
This is where we'll
wanna
see
find that,
exactly
actually.
how the dust settles here, and I mean some of the planning opportunities are in the minutia, and we've got to see how all those details shake out, because right now it's just headlines, and even as Josh was reading the tax code, it was introduced somewhere, but then they change it somewhere else. It's confusing. So
Yeah, I think we need another tablet for Josh.
Yeah, thanks.
And the reimbursement for bicycle commuters.
oh my goodness. See, California.
There is parking and transit stuff. If your company subsidizes that too, which would be an impact on people in Illinois.
I was just in Dallas.
They don't let you deduct your Uber?
They have the Lime bike plague in Dallas as well.
Yeah. All right, we're landing on the plane. Fourth segment. We need to
This
get to
is the
planning.
fourth segment?
Yeah. We need to get to planning opportunities. But we got to talk about the business stuff. That's the big deal. That's the
Right,
big
that's the
change.
point.
All right, so tax preparation. Deducting what you pay for your accountant for preparing your taxes under the new tax plan is gone. You also cannot deduct computer software to file your taxes. You won't be able to deduct the cost of that. And the same applies to electronic filing fees. So you can't deduct your tax preparation at all now.
We're going to make it more simple. You can do your taxes on the back of a postcard. Okay, just kidding. We made it more complicated. And all the help you need to get this done, we're not letting you deduct that.
No.
That's what happens.
But this is,
I told you that was a lie. That was never going to happen.
I know, but this is where if you are Casey and you're paying your accountant and he's allocating the way that accountants like to do 10% to the business part of the return and 90% to the personal part of the return, you say, hey, look,
Yeah.
allocated
Business.
to the business.
Yep. Okay. All right.
I got a guy.
So corporate tax rates, and then I'm going to go back to the outline and talk about, all right, we still like the HSA. Do we still like the Roth IRA? What tax planning opportunities have come out? And there again, Kevin, it's going to be, what do you need to do right now?
Move.
Move. What do you need to do to get the most out of these tax law changes? We're talking about that today. My name's Mike Bernard. Next to Josh Gregory and Kevin Korhorn. This is Wise Money with Korhorn Financial Group. Want to remind you, especially as we've recapped a lot of the most important tax law changes and interjected some planning opportunities. We're going to hit more of those in just a second. If you've missed anything, the YouTube channel is up. Just search Wise Money Radio. And you can catch all the previous episodes on the website, wisemoneyradio.com, as well as on podcasts, Google Play, and iTunes, Wise Money with Korhorn Financial Group. If you have questions about this, and I know you will, 574-222-2000, call or text. And really, one of the action plans, we're going to hit this again, you've got to set up your tax planning appointment with your certified financial planner right now. Once again, everyone's looking at, well, how did this shake out for me? Get proactive. You want to improve your tax situation, figure out what opportunities are available, and take action. The big winners, and folks, it turns out all of these tax reforms were actually just about trying to help businesses, and it turns out big business. We've got to talk about the tax law changes for small business owners and big corporations. Let's talk about those changes.
Well, that really was the spirit of all of these tax law reform. And in my opinion, that's the reason why we can even still use the term reform to describe the laws that have changed. It's really on the corporate side. And it's all out of the spirit that when you compared the top rates that U.S. corporations pay compared to other nations around the globe.
Developed nations, yeah.
That's right. We were on the high end of the spectrum.
Second or third.
right?
Kevin just sent that around to us. I don't know if you recall. It's second or third. Highest.
So, you would argue that puts U.S. businesses at a disadvantage when they're trying to compete on the world stage, right? And this is an attempt to remove some of those obstacles, level the playing field, and really it puts some immediate profit ultimately in the hands of corporate America. That's one of the reasons why Wall Street has been on such a strong run over the past 12 months. It's in anticipation of these laws coming into effect and the positive benefit that it provides for our businesses here in the U.S.
So essentially, corporate tax rates, so C Corps, what they call them, those are big businesses. Some small companies are structured as a C Corp. There's potential double taxation, but now with these law changes, maybe you'd want to consider moving from S Corp to C Corp, but they've limited that. But essentially, the tax rate for your profits for C Corps is now 21%. The first version said 20, the next one said 22. They compromised at 21%.
Right. So if you are a business owner, whether you own a sole proprietorship, a partnership, an S Corp or a C Corp, you want to be talking to your tax planner about entity structure.
That's right.
And based on your situation and the new tax law changes, what entity structure is appropriate for your situation
So
right
let's talk about those sole proprietors, those S Corp or LLC. They're all called pass-throughs. So if you haven't been living in a hole and you've heard a lot of news about the tax law changes, you've probably heard the word pass-through a ton. And you might have wondered, well, does that apply to me or not? I actually was stopped, YouTube can see, I'm drinking Starbucks, my favorite vice, and in line talking to a business owner friend of mine, and he wasn't sure. Am I under a C Corp or am I a pass-through? I don't know. And this guy is a successful business owner. His business is doing great. So pass-through entities, sole proprietorships, S Corps, LLC, you got a benefit but it's limited. It's not quite as lucrative as C Corps.
Well, I think it's important to, first of all, define what is the difference, because most corporations, if you own stock in Starbucks, for example, Starbucks is a C Corp, is what we call it. It's just a standard corporation, which means as they sell Mike their overpriced coffee, there's a whole bunch of profit built into that. Mike is lining their pockets as we speak, and that profit gets taxed at corporate rates. Used to be 35, some have said 39% when you work everything, right? Now going down to 21%. But that's not how most small businesses are structured. Most small businesses that we run into are either a limited liability company or an S Corp. And what that means is the business itself doesn't pay income taxes. Instead, the profits flow through to the owner's tax return, and they pay tax at their rate. That's what we mean by a pass-through entity. The income passes through to your personal tax return.
So now on your personal return, there are lower, there's still 7 tax brackets, but those are lower. But some of the deductions are gone. So what they've done to hopefully stimulate small businesses is created a deduction from those profits. Is it 20 or 25%? I don't know.
20%. Yep.
From those profits. Just they give you a deduction right off the bat. However, they have put they've added a couple strings to that. One is the deduction cannot exceed what you pay yourself. That's interesting.
Yeah.
Okay. And second is they are limiting this to professional service organizations. Turns out that's accountants, attorneys, financial advisors. So there are limits in there where, I'll just be honest, folks out there, yeah, this tax law change is supposed to be about businesses, and at least Korhorn Financial Groups and firms like ours lost.
But, so here's how we win, though. In my opinion, this is one of the greatest complexities that's added to the tax code. This is
Totally.
messy. I mean, your eyes will go across, your head will spin when you try to read through this. And if the CPAs listening today have ever wondered whether or not they have job security, this is it, right? Small business owners, it was complicated before. Now figuring out how do you apply this deduction, how much of it are you eligible for, and more importantly, how do you adjust your game plan for how you structure your wages and things like that. This just got more complicated, and you need a tax planner working with you, not just a tax preparer.
So Kevin's used this phrase before. If you own a small business, run, don't walk to your certified financial planner's office and talk to them about how you're going to structure your income, what all of this means to you, whether you should change your entity structure, whether you're even allowed to, and then what adjustments you need to make. You get into April, you get into July, you get into October of next year, it's too late to make some of these changes. So get into your certified financial planner's office. Why not your CPA? Because their entire objective is to try to get an accurate tax return. Rarely do they focus on what can you do proactively to improve your situation. That's why we say you've got to work with your certified financial planner, and that certified financial planner needs to be collaborating with your tax preparer.
And this is such an important time of year. If you are a business owner, and you hear us talking about S Corps and LLCs and things like that, every year you have a window of time from January 1st until March 15th to decide whether or not you're going to make this election. Mm-hmm. So it's a limited opportunity. You have to rule it in or rule it out, decide whether or not it's going to make sense for you, which means you have to be proactive in this area of planning. You need to be forecasting, what is 2018 going to look like for you? You haven't even prepared your 2017 taxes yet, and we're already telling you need to be thinking about 2018.
Yeah. So let's recap some of the things that you need to do today or tomorrow. First, if you owe state taxes or you think you're going to owe state taxes, write an estimate. Get it postmarked, get it in the mail before 2018. Second, if you have donations that you need to make, gifts that you do each and every year or that you wanted to do and I don't know, you might not itemize next year, and if you do, it might not give you the same boost. Get those deductions in this year. Businesses, with your tax rates going down, if you've got accounts payable, if you owe someone money, I'd make sure you're paying that this year, because next year you're going to have more deductions that you can take, potentially even a lower tax rate. And then lastly, I'd highlight again, run, don't walk to your certified financial planner's office. Don't just look at these tax law changes and say, well, how'd the dust settle? No, take a proactive approach and saying, I'm going to get the most out of these tax law changes, and I'm going to capitalize on the opportunities out there. So that is all the time we have for today, folks. On behalf of Kevin Korhorn, Josh Gregory, and myself, and all of us at Korhorn Financial Group, have a safe and happy new year, and we'll see you next year here on Wise Money with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.